Interested in building your own dividend portfolio but don't know where to start? Interested in buying Canadian dividend stocks? Looking for stocks that pay a stable dividend? I will be recommending and breaking down 2 Canadian dividend stocks that you can buy and hold forever to earn consistent and reliable income. For any of my US subscribers, these 2 companies are also listed on the New York Stock Exchange, so you don't feel left out. Make sure to check out my previous video where I recommend my 2 favorite Canadian dividend paying stocks. Keep in mind, they're also listed on the New York Stock Exchange. Full disclosure, I own both of these stocks. I have around $10,000 invested in each. And my previous video, I own those as well. I have around $20,000 invested in them. So there's a little bit of a bias, but obviously I invested in them for a reason. The 2 stocks I'm recommending are BMO, ticker BMO.TO on the TSX, and Fortis, ticker FTS. The last video was a similar format, 1 bank and 1 utility. It wasn't on purpose, I just think these companies are legit. I haven't said this in a few videos, but I just want to remind everyone, please thumbs up the video and subscribe to the channel for more content. First stock I'm recommending is BMO. Bank of Montreal, or BMO, is the 4th largest bank in Canada in terms of market cap at around $34 billion. To put it into perspective with the top 2 banks, TD is at $80 billion and RBC is at $96 billion, so there's quite the size difference. BMO is 203 years old. They were founded in 1817 and they've been paying dividends for 191 years. That makes it the longest running dividend payer in Canada. Not only have they been paying their dividends for that long, but they've also been increasing their dividends for the past 8 years at an average rate of 5%. The current yield at the end of July 2020 is around 5.65% and they pay quarterly. Given the recent economic conditions in 2020, I think their dividend increase streak will come to an end, but I don't think their dividends will come to an end. At the beginning of 2020, their shares hit a peak of $104. Then they tanked hard to around mid-50s in March 2020 and have been slowly climbing back up. At the time of making this video, the stock is $75 per share. That's still a good 25% discount from their all-time high. Analysts are targeting a price of $82 by summer 2021. So ideally, you'll experience a 10% stock appreciation and a 5.6% dividend payment within the next 12 months. If you're wondering or you're afraid of how the recent economic conditions will affect BMO, you'll be happy to note that BMO has the lowest exposure to mortgages and Canadian housing out of all the big 5 banks. Any adverse housing effects or mortgage defaults or housing crash should affect BMO the least out of all the banks. Their Q3 results aren't out yet, but for Q2 it was a bloodbath, understandably. Their net income dropped from $1.52 billion in 2019 to $715 million in 2020. They've also increased their allowance for doubtful accounts, or the provision for credit losses, by almost 500%, from $313 million in 2019 to $1.46 billion in 2020. This means any future credit losses or future credit issues, any economic downturn, where some Canadians can't pay their debt, would already be priced into the current stock price. I'll include a link to their most recent investor presentation if you'd want to take a look. They outline their current strategy, how they're adapting to the current market conditions, and what they're planning to do in the future. This should not only give you comfort in the short term, but if you take a look at their balance sheet, their cash on hand, their provision for credit losses, and their positive outlook and guidance on the future should make this stock an attractive buy for anyone. Without going deep into their financials and spending another 10 minutes on BMO, I might wait for maybe their annual results at the end of the year. I recommend BMO for any dividend investor. I own around $10,000 worth of BMO shares and I won't be selling anytime soon. My second recommendation is Fortis. Fortis is a utility company. They operate in Canada, US, Central America, and the Caribbean. They have a current market cap of $25 billion. This is a defensive stock. It is a great long-term investment. Why is this a defensive stock? They released their results on July 30th, and for a crisis-filled 2020, they were still able to show an increase in earnings per share of 3.7%. Most companies are recording and reporting a decrease, but they're showing an increase. The company also has liquidity of around $5 billion. That means they're well able to withstand any potential setbacks or hardships in the short term. Fortis at the time of making this video is around $54.55 per share with a modest yield of around 3.5% payable quarterly. The company was trading at around $59 per share pre-crisis and tanked 27% to $42 per share. It's not as big of a drop as many other companies experienced. Regardless, Fortis is almost back to their all-time high, but you're still getting at a small discount at around 54 to 55 per share. On top of all that, analysts are targeting a price of $65 by summer 2021. So you might be able to get a 20% capital appreciation on top of the modest 3.5% dividend. Here's why it's good for any dividend portfolio and why I'm recommending it as a buy and hold forever. They've been paying dividends for 48 years, but not only that, they've been increasing their dividends for 44 years straight. Imagine enrolling in their DRIP program 44 years ago and having the dividends plus that growth compounding over 44 or 45 years. You should always look at a company's financial statements before buying the stock. The cash flow statement, the cash flow from operations, is one of the most important indicators of the financial health of a company. Without a positive number in this cash flow from operations, a company cannot sustain itself in the long run without borrowing money. Their normal operations aren't enough to pay their expenses without borrowing, and that's a problem. Let's take a look at the Fortis cash flow statement. You can see not only is it a positive number, but the quarterly and year-to-date figures are increasing. They're able to operate their normal business and generate $725 million in Q2 or $1.3 billion for the first half of 2020. They can use this cash to either invest or pay down debt. I'm going to quickly read a snippet from the Motley Fool on their analysis and why you should invest in Fortis. It says, "Let me give you 4 reasons why Fortis is a must-own stock for ordinary investors. You don't need a full understanding of the market condition to invest. When the market is volatile and you are a risk-averse investor, this utility stock is the safest choice. If you want a stable dividend income, only a Dividend All-Star can make it possible. The growth platform of Fortis is resilient, while the business is diverse and protected by regulatory mechanisms." Words are hard. Over the long term, all these plus factors should ensure the creation of shareholder value. Thanks for watching another buy and hold forever video. I'm trying to make these short and easy to understand with very little jargon. My next buy and hold video will be about REITs. I'll be recommending 2 REITs to buy and hold for dividend income. That's all for today, guys.